All right, if you've been trying to make sense of the housing market lately, you are probably feeling some serious whiplash. I mean, just a couple of years ago, it was an absolute frenzy, right? Bidding wars everywhere. And now, it feels like the whole thing has just stopped. It's completely frozen. So today, we are going to get into exactly why it's so stuck and, more importantly, what that actually means for all of us.
Yeah, why does it feel so stuck? That's really the million-dollar question, isn't it? The market's in this really weird kind of paralysis. You've got buyers who are totally priced out, but then you have sellers who are basically locked in. It's confusing, for sure. But if we dig into the data, we can start to piece together what is actually going on here.
I mean, think back just a few years. It's crazy, right? The story was all about bidding wars, almost no inventory, and prices just exploding. We're talking a 20% jump in a single year. Now, fast forward to today, and what do you see? Price cuts are becoming normal, inventory is finally starting to creep up, but prices, they are just stubbornly flat. This isn't a crash, not by a long shot. It's more like a grinding stalemate. And that's why we're calling this whole situation the Great Housing Freeze. It's this moment where all the normal gears of the market have just seized up, trapping both buyers and sellers in this weird state of economic paralysis. Okay, so we've got the symptom down, right? The market is frozen solid. But what's the cause? To really get it, we need to look under the hood at the economic engine that's driving this whole shift. What are the actual mechanics at play here? And to do that, we're going to pull out a really powerful tool from the world of macroeconomics. It's something that actually explains what's happening in housing almost perfectly. It's called the housing Phillips curve, and it's all about the fundamental relationship between how many homes are for sale and where prices are headed. So what is the housing Phillips curve? Look, in simple terms, it just says that when the supply of homes for sale goes down, price growth speeds up. And you guessed it, when the supply of homes goes up, price growth slows down. It's a classic seesaw, an inverse relationship. At the end of the day, it really just boils down to basic competition. When there's a super tight supply of homes, what happens? Buyers have no choice but to fight each other for what's available, and that drives prices up. But flip that around. When there are tons of listings, suddenly it's the sellers who are competing for buyers, and that puts the brakes on price growth. Simple as that. And you know what? The data we have backs this up perfectly. Just look at the pandemic frenzy. A 1-month drop in inventory led to a mind-blowing 7.2% increase in prices. Now, as the market cools off, a 1-month rise in inventory is linked to a 1.5% slowdown in price growth. The relationship is just crystal clear. Okay, but wait a second. This brings up the next big question. If the Phillips curve is right and inventory is going up, then why aren't prices falling off a cliff, right? What's stopping the market from really correcting? Well, the answer isn't just in the economics. It's in our heads. To get to the bottom of that, we have to figure out why sellers are so reluctant to budge on their price. And this is where we get into the human side of the whole thing, where psychology and your personal bank account are keeping sellers locked in place. It really comes down to this powerful 1-2 punch. There are two huge forces at work here, and they're teaming up to keep prices sticky, especially on the way down. The first one is psychological, a quirk in how our brains work, and the second is just a cold, hard financial calculation. So that psychological piece, it's called loss aversion. And there's fantastic research on this from the National Bureau of Economic Research. It basically shows that for most of us, the pain of losing something feels about twice as bad as the joy of gaining something of the exact same value. And this has a massive effect on how sellers think and act. So let me show you how this plays out in the real world. Let's say you bought your home for $500,000. That number, that $500,000, becomes your mental reference point. Now imagine the market shifts and the value drops to, say, $475,000. Selling at that new price feels like you're taking a $25,000 loss, and that hurts, even if it's the new fair market value. So what a lot of sellers do? They hold out, waiting for their original price, and that's a huge reason prices stay so sticky. But hey, it is not just psychology. There's a really stark financial reality going on here too. Get this, a whopping 80% of American homeowners have a mortgage rate below 5%, and even crazier, about a quarter of them locked in rates under 3.5% during the pandemic. This has created what economists call the lock-in effect, and it's maybe the biggest financial reason people are not moving. So, what does this actually mean for a homeowner? It means that for most people, selling their current home would mean swapping out a sweet 3% mortgage for a new one at 6% or maybe even 7%. I mean, that could literally double your monthly payment. For so many families, it's just an economically irrational move. And that's a huge, huge reason why so few existing homes are even hitting the market right now.
All right, so that pretty much explains the gridlock we're in right now. But let's zoom out and look ahead, because there are two massive shocks to the system. One is demographic, one is financial, that are about to completely reshape the housing market for the next generation. The first shock is all about demographics. Over the next decade, there's this slow-moving but absolutely enormous wave of what you could call shadow inventory that's about to hit the market. We're talking about an estimated 15 million homes currently owned by baby boomers who are going to be downsizing, moving into care, or, passing away. And the second force? It's the rise of giant institutional investors. See, as regular families are finding themselves priced out, huge corporate landlords have been swooping in and expanding their portfolios at a really astonishing rate. We're not talking about your local landlord. These are firms that own tens or even hundreds of thousands of single-family homes, and they have billions in cash just ready to go. That creates a level of competition that most of us just can't match. And this is where those two big forces collide. As that massive wave of boomer-owned homes starts to come onto the market, who's there to buy them? Well, these large institutional firms are perfectly positioned to be the buyer of last resort. They can absorb all that new supply and turn it into rental properties. So, what does this all mean when you put it together? What's the big takeaway? When you combine the current market freeze with these huge long-term trends, the demographic shift, and institutional money, it's pretty clear we're entering a brand new era for housing, one with a totally different set of rules. So let's just run through the key takeaways real quick. 1. The market is stuck right now in a massive affordability gap. 2. Seller psychology, that loss aversion thing, is keeping prices sticky. 3. A huge wave of supply from the baby boomer generation is on its way. And 4. Institutional landlords are in a position to reshape who actually owns all those homes. There's a quote from a UVA Economic Insights paper that just nails the entire story. It says, "Cheap money built this boom. Expensive money exposed its fragility." That really says it all, doesn't it? The era of super low interest rates built this whole thing up, but now that money's expensive again, we're seeing just how fragile it all was. And all of this leaves us with one final and really critical question. As these powerful forces of demographics and big money continue to reshape the entire market, we all have to start asking, in the future, who actually gets to own a home?